Hello everyone. Today we're going to have a brief market recap, then talk about sterling and the UK labour market data that's coming out today. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment. Well, bond yields fell back, but the dollar continued to gain anyway on solid economic news for the U.S. Yesterday's U.S. retail sales and Empire State Manufacturing Index both beat expectations. Plus, the market expects the new administration to change the tax laws to encourage companies to repatriate profits from abroad. At the same time, bond yields finally found a bid after the worst three-day losses since 1989. As the dollar rose, the yen fell with no particular impetus behind the move. Macro and systemic traders are apparently buying dollars against yen and euros. The Bank of Japan's pledge to cap 10-year bond yields at zero may be depressing the yen as interest rates move up elsewhere. That makes other bond markets much more attractive than the Japanese bond market. Now, oil soared on news that OPEC Secretary General will go to Iran, Venezuela, and Peru for talks. He met with the Saudi oil minister recently. Personally, I don't think anything's going to come with this, but people have to be careful. Anyway, the rally was capped after the API reported a much larger than expected 3.65 million barrel rise in inventories. Now, there's a lot going on in sterling. Sterling initially fell yesterday after the UK CPI missed estimates. Also, during the day, there were some reports out that led people to think a hard Brexit was more likely. For one, the BBC reported that the government's drawing up a bill to trigger Article 50 if they lose the Supreme Court appeal. The bill would limit Parliament's ability to attach any conditions to the government's negotiating stance. Plus, the Labour Party confirmed that it won't block the Brexit bill. But late in the day, there was some news about possible delays to the whole Article 50 process. That sent sterling back up slightly. Now, the momentum for sterling might be maintained today as Britain announces its monthly employment data. Both the claimant count rate and the unemployment rate are expected to remain the same as in the previous month. That would be the third consecutive month for the claimant count rate at 2.3% and the fifth month for the unemployment rate at 4.9%. In short, the data are likely to show the UK employment situation is steady. That's actually not bad, given that hiring intentions have been weak, and of course the economic picture has been pretty uncertain in Britain since the Brexit referendum. So if the data do come in as expected, I'd expect the currency also to be steady to higher. For an update on the US indicators coming out today, please watch my North American opening market comment. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.